This is terrifying. I'm your host, Steve Van Metre, and thanks for joining me today. And we just got a shocking report for retail sales in November that says sales went crashing. And let's put this in perspective, because retail sales in November, it should be a big month. November is one of the biggest shopping months of the year. It's a long month. People are out shopping for the holiday season, and the numbers are usually rather good. Now, on a year-over-year basis, retail sales are up, but on a monthly basis, they came tumbling down. And what did we hear from the Fed? Well, that isn't enough. They want to see even more, because when you start connecting the dots, when you start to see the big picture come together, as retail sales go down, layoffs go up. And when asked about that, when asked about the unemployment, the state of the labor market, Fed Chair Powell had the audacity, if you can believe this, he had the audacity to say he wants to see unemployment go up and wage growth come way down, because he says people are making too much money, their wages are growing too fast, and until those come down, inflation isn't going to come down fast enough. So let's pick this story up. Let's head over to Bloomberg, because I want to get into today to show you why retail sales coming down means layoffs are going up. Powell says Fed still has a ways to go after a half-point hike. And get this, officials cut their 2023 GDP forecast, raise unemployment. They're telling us they want to see unemployment go up because they're tightening monetary policy. We still have some ways to go, Powell said during his press conference on Wednesday, after the Fed raised their benchmark rate by 50 basis points to 4.25 to 4.5. Policymakers projected rates would be in next year at 5.1%, according to their forecast, before being cut to 4.1 in 2024. So now, to put this in perspective, you get this odd number of 5.1% because the Fed usually only moves at quarter percent increments or higher. So what does this kind of mean to us? It means next year we should see, at least my expectation is, if the Fed continues to hike, and we'll put a big question mark on that one. If they continue to, I expect the pace to slow down to 0.25%, which would imply that we would likely see 0.75% hikes next year, and then they'll plateau out, and then sometime in 2024, predictably toward the end of it, as we talked about in a prior show, where the Fed ideally wants to see a plateau where rates stay flat for about a year. So we would expect them to see toward the end of 2024 them to start to cut rates. Powell said the size of the rate increase delivered on February 1st at the Fed's next meeting would depend on incoming data, as it always does, leaving the door open to another 0.5 percentage point move or step down to 0.25 point. He pushed back against bets that the Fed would reverse course next year, even though the market says otherwise. And this is fantastic because, when you look at Fed Chair Powell, he is not a PhD economist. He came up the ranks from private industry. He said in the past he understands what the bond market is telling us, and what the bond market is clearly saying, that he is going to backtrack these hikes, not in a little way, but in a big way. Let's take a look at this chart. Here we see the federal funds effective rate in blue against the 10-year Treasury constant maturity minus 3-month Treasury maturity. This is one of the various yield curves showing the 3-month yields are now higher, or still higher than 10-year yields as they've been. But notably, I want to point out that we're now seeing the biggest inversion in the history of this chart. According to the St. Louis Fed, this is the biggest inversion we have going back to the 1980s. So this is making a clear statement to Powell, you got this wrong, buddy. And here you can see every time, as we pointed out, these inversions, the market plateaus, or the federal funds rate, not the market plateaus, and then soon heads lower, and that's what it's indicating here. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way, Powell said. Restoring price stability will likely require maintaining a restrictive policy stance for some time. And again, this just validates kind of what I just mentioned, that Powell ideally wants to raise rates a few more times into early next year and then run a plateau for about 12 months. And then hopefully by then he thinks that inflation will come down, and that will start to bring of course, the federal funds rate down with it. But of course, as we can note this week, we got some data from the import price index, which is just another point of validation that Powell's got it wrong and he's be cutting rates a lot sooner than he thinks. Here you can see the consumer price index in blue and the import price index in red for all commodities on a year-over-year rate of change. As we pointed out in prior shows, the CPI is heavily dependent on two factors, gasoline prices and import prices. And here you can see import prices rapidly moving down to the zero bar, suggesting that, of course, when it gets down to zero and below, that we get right back to the Fed's 2 to 2.5% target here. And of course, I know the Fed's target isn't 2.5%, but you can better believe if we get anywhere close to 2.5%, that they're going to backpedal really quick here. But they're not ready to do that just yet. It's our judgment today that we're not a sufficiently restrictive policy stance yet, Powell said. We will stay on course until the job is done. He's previously signaled plans to moderate hikes while emphasizing the pace of tightening is less significant than the peak and the duration of rates at a high level. And what's notable to me is listening to the press conference is he got called out that the stock market was still trending higher and that interest rates on the intermediate and long end of the curve were heading lower, indicating that financial conditions were loosening despite all this massive tightening from the Fed. And you could almost see during the press conference that Powell was angry. And I want you to understand this because as the Fed chief, he is one of the most powerful people in this world. When he says hike rates, the market should respond, stocks should go down, interest rates should go up, financial conditions should tighten, you should stop spending, you should get less, you should lose your job. I mean, these are all things that he wants, and he's not getting them, and he's very frustrated because, as we've discussed with our friend Jeff Snyder on his channel, that the Fed is largely impotent. They're not powerful. This monetary policy doesn't do a whole lot of stuff. And right now we're getting an indication that despite all these hikes, he seems rather powerless. It's going to take a while for the Fed to achieve what they want to achieve, according to former New York Fed President William Dudley said on a recent interview. They have to slow the economy down sufficiently to generate enough slack in the labor market. And here again, I want you to see from the former New York Fed president right here, so wage trends come down to be consistent with 2% inflation. And here again, this is a simple case is they want you to make less money. They want you to get less raises. They want to see it come way down. Because when you think about, kind of what the Fed can and can't do, by raising rates, all they can do is get people to question how they spend their money. So if you have a lot of variable interest rate debt and the Fed is raising rates, the cost to service that debt goes up, meaning to support that debt, you have to redirect more of your discretionary income to debt service. Or if you don't, in the case you want to go out and spend some money and you want to finance something, you might look at interest rate and say, well, you know what, maybe I don't want to pay that much in borrowing costs, and so you decide not to spend. That's really what the Fed's power here. But let's take a look at what they expect from wages, because when you see just how little they want you to make going forward, you're going to be shocked. Here you can see the consumer price index again in blue, now overlaid with average hourly earnings of production and non-supervisory employees in red, both on a year-over-year rate of change. And we can note that here wages are falling or have been growing less than inflation. Of course, we know that. Many of you said it in the comments. We hear it in the news. We see it every day. People are falling more and more behind. And what the Fed wants is your wages to be all the way down here at this level, which would be below 2%. In order to hit their 2% target, they want your wages to grow at less than 2%. Isn't that an outrage? I think it is. Now, how does this all translate back to retail sales and layoffs? Well, let's get into the retail sales report because, well, that's pretty ugly. U.S. retail sales dropped the most in 11 months, missing estimates as 9 of the 13 categories fell. The value of overall retail purchases dropped 0.6% last month after rising 1.3% in October. Excluding gasoline and autos, retail sales were down 0.2%, mind you, not adjusted for inflation. The report suggests some loss of momentum in consumer demand for goods amid higher inflation. What an absolute shocking statement that has to be. Hey, people's wages are not keeping up with inflation, so they're spending less. Well, it makes perfect sense. As well as what's been a shift in preferences towards services, while rising wages and pandemic-era savings have helped support shoppers, Americans are beginning to feel the squeeze. And again, here we get this kind of nudge. We talked about this in a show the other day that Jamie Dimon suggested there's $1.2 trillion of money sitting, just excess money in people's bank accounts. But in reality, it just doesn't exist to that extent. If it did, we wouldn't see a slowdown here in November because we did see sales. We did see retailers and wholesalers want to move inventory, and yet they didn't. The savings rate remains near a record low, and credit card balances have surged along with interest rates. November includes some of the biggest shopping days of the year, and retailers offered widespread discounts across a range of products like toys, clothing, and electronics on Black Friday and beyond. Separate data from Adobe Analytics found online spending during Cyber Week, Thanksgiving to Monday, was up 4% from last year. So again, not big numbers here, despite the fact that we actually are seeing demand now go down because people cannot afford this. So how does now all come back to the fact that people are going to start losing their jobs, even though today, what did we see in the unemployment claims? It actually went down in about 211,000, which is a great number. But I want you to look at these charts now because I want you to see what's coming for January, February, and March, as the Fed still thinks they're hiking, but the economy will say, no way. Here we have advanced retail sales in blue against the Wilshire 5000 or total U.S. stock market in red, both on a year-over-year rate of change. And what we note is that consumer spending tends to follow the stock market. This is that wealth effect that former Fed Chair Alan Greenspan talked about. Now let's move forward here and overlay the 4-week moving average of initial claims. Now this claims number is not on a year-over-year rate of change, and we're going to keep the retail sales. And notice how retail sales go down and claims go up. Retail sales start to head down, claims rise. Retail sales tick down, claims kind of go up a little bit, and here retail sales are heading down, but notably they're still from a very high point historically. So we're not quite there, because if retail sales are going down and people are spending less, what do you need less of? You got it. Less employees. And that's what makes sense here. So now you start to get what Powell is up to, is if they get people to cut spending, then retailers or wholesalers will then lay off people, and those people won't be able to spend money. That means wages will come down, and next thing you know, inflation with it. Other data on Thursday showed the labor market remains resilient with fewest weekly initial unemployment filings in more than 2 months. Meanwhile, 2 regional Fed Reserve manufacturing gauges showed weaker activity this month, as the Fed is looking for a slowdown, as I told you, in consumer spending that will lower economic growth in order to help stamp out inflation. Policymakers stepped down the pace of interest rate increases on Wednesday, while inflation has been decelerating in recent months. And now you get it. Now you understand layoffs are coming. What we see in retail sales is a leading indicator. And yes, policymakers want this. They want to see you on the unemployment line. They want to see you go to the boss and get a smaller raise. And that, to me, my friends, doesn't make any sense. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.